thank you. That concludes my part of the presentation. And do we have any questions?
Yes. Yeah, we're going to go to the question and answer in a couple of minutes. I just want to, one question, we've got a couple of people asking, are we going to mail out the slides? And yes, everybody will receive a PDF copy of all the slides used in the presentation today. And the other thing I just want to mention is when you call into the, when you called in on the phone, you need to, if you want to ask a question, you need to put in not only the access code, but then there's another code. And if you didn't put in that last code, then you can only hear the presentation and you won't be able to ask a question. So if you didn't put in the last code, you need to, and you would like to ask a question, you need to hang up, call back in on the telephone, and put in both of the access codes. Otherwise, you can type in a question. So we're going to go to the audience questions in a moment. Now's a good time, if you do have a question, to click on the little hand icon. But before we do, I have a couple of questions. Jay, would you describe how you see the ideal client for the 2010 strategy?
Well, I think this strategy probably fits in most people's portfolios. If you believe that we have a broad-based economic recovery, if you believe that inflation could be a problem down the line, if you believe that the dollar may be under pressure, and that eventually short rates on the part of the Federal Reserve will be pushed up. So this is probably pretty much consensus thinking. This is not a one-off or just KCM's thought process. I think that what we're saying is consensus, and in this case we happen to agree with the consensus. And you also have to believe that the emerging market economies are going to grow faster than the United States. So little inflation, a dollar weakness, strength away from the United States, and a continued broad-based economic recovery. And then you need to believe that the companies that pay dividends that we're going to choose are the solid, good American multinationals that you can live within, and will continue to pay their dividends.
Okay. Another question is, many investors have large amounts of cash right now that they're afraid to invest in bonds. And on the municipal side, some investors are concerned about the credit quality of the state of California. Others are concerned about the specter of rising rates. So, Jay, how would you advise clients that have these concerns?
Well, in terms of the specter of rising rates, I think this graph tells it all, that even in a rising rate environment, that there are some places on the curve that you can go, especially with California general obligation bonds, that can make some sense, that can give you a decent return. Now, the state of California is our favorite credit in the country, literally. And the reason for that is that the state constitution says two things. It says that you must pay for education and you must pay bond principal and interest. 40% of the revenues of the state of California, not the budget of the state of California, but the revenues of the state of California have to go to education. Then the Constitution also says you must pay bond principal and interest. It's not appropriated. Nobody has to sign a bill to say to pay the bond interest. The controller simply goes into the state treasury, writes the check, and pays it. So that is approximately 7% of the budget, and that includes the public works bonds, by the way, not just the general obligation bonds, presently 7% of the budget. But let's just pretend it goes to 10% of the budget. So 40% for education and 10% for bond principal and interest. That still leaves a 50% of the revenues of the state of California as cushion for bond principal and interest. And keep in mind that really, as I say, the mother's milk of every project that a state does is the ability to borrow at low rates. And it's inconceivable that a state would jeopardize to any extent their ability to borrow at these extremely low tax-free rates and not have the access to the capital markets. Finally, a state cannot declare bankruptcy. There's nothing in the bankruptcy laws that allows the state to do it. And I can't imagine for a second that if any state got into so much trouble that they were close to bankruptcy, that the federal government wouldn't come to their aid. Also, every month, certainly since December, and I think since November, state revenues have been higher than budgeted. So clearly in a recovery like we're going through now, the revenue picture and therefore the credit of the state will improve. You probably have all noticed that the rating services have changed the way they've recalibrated the ratings. They haven't really upgraded the state, but the state is now single A across the board, single A1, in fact, by Moody's just the other day. And Fitch raised it to an A- credit I think on April 5th. So we're very comfortable with the state of California, and we're very comfortable with our analysis of where you might go on the curve to get some extra yield, even in a rising interest rate environment.
Okay. And my last question before we go to the audience questions is, how important do you think it'll be to adjust the bond strategy going forward in light of the changes that you expect in the yield curve?
Yeah, it's very important. And one of the things, you can see the analysis that we do and why we pick spots on the curve and to overweight or underweight. And this is an example, the chart that you see in front of you right now, of why we would still invest out, say, 10 years with a California general obligation bond, even in a potentially rising interest rate environment. In late 2008, there's another example where we had blowups of leveraged bond funds and leveraged hedge funds, both from the short end, they lost their financing, and from the long end, they got margin calls. And the yields on some 20 to 30-year California bonds, well, bonds all across the country for that matter, got north of 6%, as high as 6.5%, from 4.5% a few months earlier. Well, you want to take advantage of that, and we did to the extent that we could, and you put a portion of everybody's portfolio out there to take advantage of what's clearly an aberration in the market. Another aberration in the market that we talked about just briefly was the Build America bond program, and we certainly use those in the corporate bond portfolios with the idea that that spread will be narrowing. So we're always looking for opportunities to adjust the portfolio to what we think are the optimum spots on the yield curve.
Okay, thank you. And so if you have a question, click on the little hand icon and we'll take the questions. And I have one here that was typed in, is what dividend yield roughly can clients expect on the 2010 portfolio?
The actual portfolio has approximately 2.56 was the last yield I looked at yesterday. So the dividend payers, which are 50% of it, probably average 5%, give or take, and the whole portfolio averages 2.5%.
Okay. So I have another one that was typed in here. On the municipal bond area, how do we feel about revenue bonds versus school districts and GOs and et cetera?
The revenues, GOs, school districts, certainly you got to watch school districts. We no longer, of course, have the rating agencies, and depending upon their AAA rating. So you look at very carefully at the underlying rating on school districts. School districts are particularly hard to figure out, or for that matter, a county. There is no way to know, as an example, that San Mateo County had $150 million plus of Lehman Brothers paper, commercial paper, that they had bought shortly before Lehman went bankrupt. You can't possibly know that. So school districts in the best of neighborhoods are difficult. The financials, we would be lucky to get 2009, be lucky to get 2008 financials if we wanted to look at a particular. They just don't keep them updated. It's difficult to get information. But having said that, the essential services bonds, water, sewers, good school districts, we're all very comfortable with. But we're also very comfortable with general obligation bonds with the full taxing powers of states, and California in particular we think is the true value. We all live in California, and it's I think we understand the credit well, and we like it.
We have another question that was typed in here. Is what is the minimum for each portfolio and fee? Well, I can answer that one. Our fee on fixed income is 50 basis points per year, and our fee on all of the equity strategies, including the 2010, would be 90 basis points per year. And if it's a balanced account, it's a weighted average of the two. And we have a minimum fee per year, which is $5,000. So we have a minimum fee. I would say generally, we're looking for accounts that are $1 million or more. But another good question that was typed in is, what investment vehicles do you plan on using for commodity, emerging market, and currency exposure?
Well, for commodity exposure, gold, copper happen to be the two that are in there at the moment. What was the other? Emerging markets?
Emerging market currency, yeah.
We're not using emerging market currencies necessarily. The currencies that we have now would be the Canadian dollar and the Australian dollar. That can change, but those aren't emerging markets. The emerging markets that we would put in the portfolio, I don't know if you can call China an emerging market anymore, but we have China, India, Latin America. What else do I have in here? The emerging market ETF. And that looks like it. Okay.
Let's see, another typed in question was, how do we feel about Ginnie Maes right now?
One of the problems with any mortgage security when we're at the real low end of mortgage rates historically in all of our lifetimes, we haven't seen rates this low. So if mortgage rates creep up, and they will, the duration of mortgage-backed securities, and that includes Ginnie Maes, will extend considerably, where a few years ago in a roaring bull market, whether it be Fannie Mae, Freddie Mac, or Ginnie Mae, some of them had durations of less than a year. People kept refinancing them. And the problem with the Ginnie Maes is structure, that if you get a loan and it's locked in and you like the rate, you're not going to refinance it. And so as an investor, you're locked in at those lower rates. Just the opposite happens in a declining interest rate environment. If you buy pass-through securities, it gets taken away from you and you're forced to reinvest, and your duration becomes very short. In the kind of market that we're about to enter, the duration is going to extend. The downside risk is a lot greater than the upside potential, and that's because of the structure of any mortgage security. So it's not our favorite. Ginnie Maes, Fannie Mae's, Freddie Mac pass-through securities at this stage in the cycle are probably not where you want to be.
Okay. Let's see, do we have any more questions from anybody in the audience on anything?
Hey, Jay and Ray, this is Eric. I just have a comment. Sure. After sitting through the presentation, I again think that there's a great opportunity here. I mean, we heard from Jay about the opportunities on the fixed income side, and to answer one of Ray's questions about what would you tell a client who's asking about fixed income markets is obviously you need to get some help, and you need to have a money manager here. It's too complicated to do it on your own. And then secondarily, if they are concerned about inflation, we have a great solution here where we have a firm that has great fixed income expertise as well as now a strategy around protecting against inflation. So again, from my perspective, that should really resonate with a lot of your clients.
Well, it looks like we have no other questions. So again, we'd like to just thank you for taking time out. I know your time's valuable, and if you have any other follow-up questions, or if you'd like to schedule a client meeting, just give me a call, and we'll schedule a meeting with the appropriate portfolio manager. And again, we thank you all so much for your time today.
Yes, thank you very much.
Thank you, gentlemen. Thank everybody.
Bye-bye.